So most of the time, investors are interested in buying high growth stocks, whether it's an Nvidia, a Palantir, a Microsoft, or a Tesla. But sometimes consumer defensive stocks, which are quite boring companies like McDonald's and Coca-Cola and Pepsi, they can also be great investments when they're attractively priced. And recently, they look pretty attractive because of a recent crash in the price. So let's take a closer look in this video. So you may have noticed that this year, a lot of stocks that people normally view as safe stocks are down pretty significantly, down double digits. So for example, McDonald's is down 17% from its high, a big drop for a safe company. What else? You've got Yum Brands that owns KFC that's down, or that was down, also about 17% from the highs. You've got Coke and Pepsi also down like 19%, almost 20% down, right? So you can see Coke has dropped significantly from the highs. You've got Pepsi as well. Pepsi also down like, boom, down like, close to 19%. And you've got like Hershey's, that's one of the top chocolate makers, that's down 30% from the highs. So what do all these stocks have in common? Why are they going down? And is it an opportunity to buy them as investors? So first and foremost, understand that these stocks are known as consumer defensive or consumer staple stocks, same thing. These are companies where they sell a product or service that is a necessity or that we use almost every day without thinking about it because they are normally low price. And it's not dependent on the economic situation for us to buy these things, right? So whether the economy is doing well or not doing well, we still eat chocolate. We still go to McDonald's. We still go to KFC. We still drink Coke. We still eat snacks from Pepsi. So these are known as very defensive companies. Why? Because in the worst recession, you still eat chocolate. You still drink Coke. You still drink Pepsi. So they've got very predictable revenue, profits, and cash flow. And hence they are deemed as very safe companies. But at the same time, they don't have very high growth rates. So like Nvidia and Microsoft, technology, they grow at 20-30%. But Hershey's, McDonald's, and Coke, they don't grow at 20-30%, they grow at 8%, 9%. So it's very low growth companies. Now you may be wondering, why would I want to buy a low growth company? Where can I buy a high growth company, right? The reason is because these stocks, again, are very defensive, which means that when you have them in your portfolio, when there's a bear market or when there's a recession and all stocks are dropping like flies, these stocks don't drop very much. In fact, these stocks may even go up during a recession because they are very safe and defensive. So it's useful to have these stocks in your portfolio as a way to defend or to buffer your portfolio during big market crashes. But the trouble is, most of the time, these stocks are very expensive. Yeah, most of the time, they are very overvalued. But once in a while, they get undervalued, they get cheap. And that's when I like to start accumulating these stocks. So usually consumer defensive or consumer staple stocks, they tend to go up a lot. They tend to be overpriced when people fear a recession. Because when people are afraid, oh my God, the recession is coming, they run and buy all these safe stocks. So they go up a lot. So for example, if you go back to 2020, which was during the COVID recession, you go back to 2021, you go back to 2022, right? So the last 3 years when there was a lot of fear of recession, people bought these safe companies. And so, Coke and Pepsi and P&G, they were very expensive the last 3 years. But this year, the narrative has changed because now they're saying, hey, the US economy is really strong, GDP is growing, there's no recession. So now people are dumping all these safe, boring companies and buying the more exciting technology companies. And that's why this year, Meta and Microsoft and Nvidia are flying really high. And these defensive stocks are like crashing because they're out of rotation, right? And that's precisely when I like to buy them. Because remember that as a value investor, I like to buy things that are hated, that are out of rotation, because that's when I get them cheap. For example, if you recall last year, technology was hated. Last year, consumer cyclicals were hated. They were out of rotation. So Meta, Microsoft, Nvidia, Amazon, they were dirt cheap last year, so I added more and more shares. But this year, you can see that they are the 3 best performing sectors. They are in rotation. Last 3 years, consumer defensives were in rotation, doing really well, but this year they are out of rotation, and so they are underperforming the market. And again, that's when I want to accumulate them, not all of them, but the high quality consumer defensive stocks. So if you want to buy consumer defensive stocks, you have to understand that compared to technology, they've got very low growth. So in the long run, of course, technology stocks will outperform consumer defensive stocks. Like you take a look at this chart, for example, and you can see over here, we have got XLK. This is the technology ETF that consists of all the technology stocks. And then you've got XLP, which is the consumer staples or defensive ETF that consists of all these consumer defensive stocks like Coca-Cola, Pepsico, Johnson & Johnson, Walmart, Procter & Gamble, all these boring companies. And again, you can see that over time, technology stocks, of course, have very high growth, and they of course grew a lot more than the consumer staple stocks. In fact, in the long run, the consumer staple stocks, in general, they may just be on par or slightly below the S&P 500. So again, you may be saying, why would I want to buy this if it's not going to beat the S&P, if it's like on par? Why? Because like I said, in your portfolio, if you want to buy these stocks, don't buy too much of it, because if you've got too much of it, it won't beat the market. But it's good to have some of it because they defend your portfolio from big drawdowns. Like in a bear market, in a crash, they reduce the volatility of your portfolio because they're more defensive. So let me show you the next chart to explain what I'm talking about. So again, if you look at this chart, you can see the S&P 500 versus again the XLP, which is the consumer defensive ETF. And again, you can see they are more or less on par over the last, this is back till 2008, right? So this is the last 15 years, right? So it's more or less on par. But notice what happens during market crashes. Notice, for example, when the S&P crashes this amount, the consumer staples, they drop less, right? When this drops more, this drops less. This was during the financial crisis when the S&P dropped 55%, consumer staples dropped less. So they are less volatile. That's the good thing about it. But they also do not outperform the S&P 500. Now, having said that, this is all the consumer defensive stocks in general. And of course, I don't want to buy all of them because not all of them are great. But within this basket, there are some consumer defensive stocks that are defensive and they can also beat the S&P 500. These are the ones I want to buy. And if I can buy them when they are very undervalued, I can get a return that outperforms the S&P 500. So these are some of the higher quality defensive stocks that are able to beat the S&P 500 over the last 5 years. And at the same time, they are less volatile. They are there to defend your portfolio. So over here, you can see the SPY is the S&P 500. And again, we are only interested to buy stocks that can beat the S&P 500 with lower volatility, that are in the consumer defensive industry or sector, right? So which has been the best performer? Well, Costco. Costco is one of the best defensive companies, but it's not dropped that much, but it dropped a bit, which was an opportunity as well. You have got P&G that also outperformed the S&P 500. That's not bad. Hershey's tends to outperform the S&P by a huge margin. So Hershey's is one of the high quality companies. And you've got Walmart as well, Pepsi, McDonald's, right? They all beat the S&P 500. The only one that doesn't beat the S&P 500 in the last 5 years is Coca-Cola. Yeah, so I don't like Coca-Cola, right? So the rest of them, I like them pretty much. Now, like I said, this particular year, a number of these defensive stocks have been hit very hard for two reasons. The first reason is because the entire sector is out of rotation. Because there's no more fear of recession, people sell them, they drop, they get cheap. But the second reason that's affecting some of the food companies like McDonald's, Yum Brand, and Hershey's is a recent news article. This recent news was what caused a crash in McDonald's, Yum Brands, Domino's Pizza, Hershey's, and stocks related to food and beverage. So this news was about Ozempic. What is Ozempic? It's a kind of drug that is now getting more popular. And right now we've got 1.7% of Americans using this drug that's been prescribed, and it's up 40-fold in the last 5 years. So people are now afraid that if more and more people take this drug, they're going to buy less food, right? Because this drug is a appetite suppressant. When you take this drug, you want to eat less. So people are thinking that if they eat less, they buy less Coke, they buy less Pepsi, less pizza, less McDonald's, and that's why these stocks have dropped. So if you ask me, I think it's a crazy overreaction. So remember that the market in the short term is not that rational. It's pretty emotional. And the market tends to overreact to good news and overreact to bad news. So if you ask me, I think that this news created an overreaction that caused many of these food stocks to be oversold. And that's where I think there's a huge opportunity if you can buy those high quality food companies that are in the consumer defensive sector that have been hit by this bad news. So let me just share two examples. There are again a lot more examples, but let's just focus on two right now. The first example would be Hershey's. Now again, if you study Hershey's, it's a pretty good business, and over the long run it has outperformed the S&P 500, but recently this year it got whacked. Again, for two reasons: because consumer defensives out of rotation, and number two, got hit by that bad news because of Ozempic, right? And now the price has gone down 30% from its highs, okay? Now, if you do an intrinsic value calculation, and if you've taken my value momentum investing course and you get the intrinsic value calculator, you calculate the intrinsic value, you will get roughly about $228. That's the intrinsic value of the company, right? And right now it's selling at $194, so it is undervalued by about 15% undervalued, right? Now, for a very safe company that's defensive, 15% undervalued is pretty rare, because most of the time these safe companies, they sell at a premium. So in full disclosure, I've already started buying Hershey's chocolates. Now, am I saying that it's going to rebound immediately, next day, next week, next month? No. Right now, it's still on a downtrend. So short term, it may still go down a bit. But if you look, in my opinion, if you look 1 year out from now, or 2 years or 3 years, I think it's going to be a lot higher, because it's going to get back to fair value once people realize that it's an overreaction from this short-term bad news. So that's Hershey's chocolates. And again, if you take a look at the longer term of the stock, right? Look at that. Wave up, wave down, wave up, wave down, wave up, wave down, wave up, wave down. So notice that during the big crashes, it finds support at the blue line, which is the 50 moving average. Now, sometimes it may go a bit below that and bounce up. That's the 50 moving average. And there's a big wave up. Again, why did we have this big wave up? Because what happened from here, 2020 to 2022, this was the period where there was a fear of recession, right? Remember what I told you earlier on? Whenever there's a fear, there's a recession coming, people get scared and they buy all these safe companies, these consumer defensive companies, so they tend to go up when there's fear of recession. But now this year, when the narrative changed, like no more recession, economic growth is strong, that's why it gets sold off over here. And take a look, it has gone down and it's now coming near the 50 moving average, the blue line, check it out. That is a very strong support. So it may go down a bit more, but once it hits that blue line, right, then we can expect it's going to, hallelujah, go up again. Again, no one can predict the future for certain. I'm not making a prediction. I'm just telling you that based on patterns, it will rebound eventually, okay? And you'll go back to or beyond its intrinsic value. especially if next year there's a fear of recession again. People think, oh my God, 2024 recession is coming, oh my God. Then people are going to start buying all these safe companies, and then you're going to get that wave up again. So next example will be McDonald's. Now I owned McDonald's previously, and I sold all my stock at $2.91, right? I sold it on the 19th of May, in fact, for a very nice profit. Now, why did I sell it at $2.91? Because my intrinsic value of McDonald's is about $2.69. So at $2.91, I thought it's overvalued and I wanted to buy something else. So I sold all my shares, I took the money, I went to buy something else. And since then, it has dropped back down to now $2.51, and I'm starting to buy it back again. Now, those of you who are subscribed to the Ultimate Investors Playbook, you can check it out at insight.piranhaprofits.com. If you subscribe, you're in my private community, you get all my live buy and sell notifications. So let me just show you the notification that went out on the 19th of May. This is on our Discord channel, our private community. So you can see over here, 19th of May, right? I shared with my students that my McDonald's covered call, because I was selling covered call options on McDonald's to collect monthly income through premiums, will be expiring today in the money. I'll let all my shares be called away at $2.85, together with the premium I collected of $6.52. My net sales price is $291.52. So that was the price that I got selling all my McDonald's shares using covered call options. If you're not familiar with options, basically it's a fancy way of selling my shares for an extra profit, right? My average cost was $179, so I got a 65% return on my investment in McDonald's. So that was back on the 19th of May. So since I sold it on the 19th of May, when it was overvalued, the price has now come back down again, right? And I now started buying it back. I've not bought back all my shares. I've bought back about 15% of my shares. So I'll be slowly buying back everything in the next few days, depending on the price action. All right, so why did I buy it back? Well, again, if you take a look at the price action, now remember that I make decisions based on fundamentals and technical analysis. So based on fundamental analysis, my intrinsic value is about $2.69. And again, as a UIP subscriber, you get to see all my intrinsic value calculations of all the high quality companies. So I do all the work basically, just have to look at all my calculations, right? Or you can learn to do it yourself through my courses as well, okay? So right now it has dropped to $2.51. So it is now below my intrinsic value. So that makes it fundamentally attractive, but I'm looking at the chart patterns. And again, look at this, wave up, wave down, wave up, wave down, wave up, wave down, wave up, wave down. That's right. So now it's hit this level of support, which is the 150-day moving average on weekly candles, and as well as a trendline support. So there's a high chance that this will be a strong support that would then eventually bounce back up. Okay. Now again, we can't always catch the bottom, and that's why I never buy at once all my shares. I just buy 15% first, and then I slowly accumulate, because it could go lower to the 200-day moving average, this red line over there. If it drops here, then I'll add more. So I keep averaging my position until I got a full position, so that when it goes up, then I will get a very nice return, and I'll then sell it again if it gets way overvalued. Now again, do bear in mind that in my portfolio, only about 20% of my stocks are these kind of safe consumer defensive stocks. The majority of my stocks are still the technology high growth stocks, so that my portfolio has a good combination of growth as well as defensive characteristics. So when there's a drawdown, when there's a crash, my portfolio doesn't drop that much. But when the market goes up, my portfolio way outperforms the S&P 500. And that's how I manage my investments. I hope you learned something new today. And if you did, great. Stay tuned for even more videos. May the markets be with you, and I'll see you guys on the next one. If you want to catch my latest videos, click on the subscribe button right now. Click on the bell so you get instant notifications once I upload my latest video. If you want to check out my online courses, go to piranhaprofits.com. We're going to learn how to invest and how to trade the financial markets and create an income from all around the world. If you want to join my live Wealth Academy program, go on to wealthacademyglobal.com and find out more about how you can learn investing and trading live online. This is Adam Khoo, and may the markets be with you.